Hi everybody, this is John Jamieson with Perpetual Wealth Systems, author of the best-selling book, Wealth Without Stocks or Mutual Funds. Welcome to our training today. We're going to keep this short. I get a lot of questions from clients and I get a lot of questions from people online who correspond with me through YouTube and Facebook and email and everything else. What should we do with this sky-high stock market that we have? What could we do? We've made some nice money. We're not sure. Should we sell? Is it going to go down? Is it going to go up? I don't know that. I appreciate their confidence in me, but I don't know that. Neither does anybody else. Okay, if they did, they'd be trillionaires. So the secret is to have a strategy no matter what the market does. Now, if you've experienced some good gains over the last 15, 16 months, that's fantastic. But now maybe it's time to start playing a different strategy. So how would you like to be able to take advantage of the S&P 500 as it goes up? If it continues to go up, you're going to make gains. But if it does go back down, as a lot of people are suggesting, in fact, we had a taste of that a couple weeks ago, if it does go back down, you don't lose a nickel. Would that be okay? That'd be tremendous. Okay, so let me give you an example of the difference between a standard account that you might have $100,000 in that's in the stock market, usually in mutual funds, and let's say that account is going to mirror what the S&P 500 does, starting from today. Okay, so let's just say the starting S&P 500 is 2,700, a little higher than that, but for round numbers, it's 2,700 today. And let's just say you have $100,000 in the market, we get together a year from now, and the S&P 500 has gone down by 15%. It's now 2,300. Now, if you had $100,000 in an account, a stock account, and it was tracking that particular index and it mirrored that, you'd be down $15,000. You'd have $85,000. All right. The second year, let's say it bounces back, comes up 15%. That's great, but it still doesn't even really get you back to break even. Because remember, you went down 15%, you're back up 15%, but the S&P 500 started off at 27, it's now only 26.45. Why is that? Real simple. When it went down 15%, it was 15% of a bigger number, the 2,700. When it goes up 15%, that's 15% of a smaller number, which was the 2,300. Right? This is why you don't even get back to break even. Okay? Now let's go on to year three. Year three, market goes down 20%. As you know, it gets beat up. Folks, we've had years very recently that were way worse than 20%. So all of a sudden, that 26.45 S&P is now down to 21.16. Your account is way underwater. You're not even close to the $100,000 that you had. But in year four, market rebounds the full 20%. But just as with the 15% scenario, it goes up 20% of a lesser number, doesn't even get back up to the 26.45, and still not near the 2,700 that you started at. Long story short, your $100,000 still isn't even, you're still underwater. But in the fifth year, market continues to go up, went up 20% in year four, continues that upswing, 12% the next year, S&P's at 28.44. You started off 5 years before at 2,700 with $100,000. What does that actually mean in dollars and cents? Here's what it means. You end up with a little over $105,000 of cash 5 years into the market. Really terrible return, but it could be much worse, right? Though that market could have been much worse than that over a 5 year period. Let's say the overall market would have been down 25% over 5 years. You'd be down to $75,000. But in this example, at least you got your 100 back plus $5,000. So, did we take advantage of the market? No, we didn't. We let the market take advantage of us. So what could we do in its place? Instead of taking the $100,000 and putting in traditional stocks mutual funds, what if we practice a strategy called indexing? Okay? And we put our money in an account where the gains are going to be measured by what happens in the index, and we have a no market loss guarantee. In other words, our starting $100,000 is never going to be less than that, and as we achieve gains, those gains are locked in and can't retreat from that level either. Okay? Also, we're going to use an annual point-to-point. What does that mean? It just means that if we put our money in today and it's 2,700, a year from now, what is that trading at? We're going to use the exact same example as our $100,000 in mutual funds. Okay? Huge, I put stars by it, is an annual reset. That becomes key for this program. What does that mean? It means that the tracking for our gains, because remember, there are no losses. So the tracking for us either gaining money or staying even that year is based on whatever the S&P 500 is trading at, but we get the new reset amount. So in other words, the first year, When we started off at 2,700, we went down 15%. S&P 500 is right around 2,300. Okay, we didn't lose any money that year. Remember, with our regular account, we were down 15,000 bucks. This account, we still have our $100,000. Okay, no fees in this account, by the way, so don't think you're going to get feed to death. Not one fee in this account, so you still have your $100,000. But just as importantly, when we start tracking for our next year gain or stay even, we start tracking at the 2,300, not the 2,700 we bought in at. That becomes critical because look what happens. Now the next year, market goes up 15%. Well, again, we're still not back up to the 2,700, but it doesn't matter in this account because our new basis for that second year was our 2,300. So our account went up 15%. Now, with this particular account, we don't get the whole 15%. We don't take any of the losses. We can't have all the gains, but you will get 50% of the gains. So that year, market went up 15%. You get credit 7.5%. Or, in this example, 7,500 bucks. So now you've got the $7,500. That's locked into the account. Now your new basis is 2645. And in our example, now you got 107,500. You're now tracking the next year, the new reset is at 2645, and the market takes a hit, goes down 20%. So if it goes down 20%, the S&P is going to end up a little over 2,100. But guess what? Your 107.5 of cash that you have, you didn't lose a dime, you didn't pay any fees. Okay? That's critical. Now the next year goes up 20%. Now, again, it goes up 20% from the 2116. Here's your new reset level with this program I'm telling you about. So if it goes up 20%, how much of that do you get? Do you remember? You get 50% of whatever the gain is, or half of whatever the gain is. So if it went up 20%, your account gets credited 10%. Okay? That's a lot of money. Now, the next year, remember, the account went up again another 12%. You get credited another 6%. So what does all this mean in dollars and cents and real money in your account? At the end of 5 years using indexing with those numbers, remember, with the normal account, you had a little over $105,000. With this account, you have $125,375. Now, folks, you don't need to be a scholar to understand which figure is bigger. I'm a simple guy. I like simple answers. 125.3 is better than 105. Now, on top of that, let's say the market, we said, could have been down 25%, and in this account, your normal account, you'd have been down $75,000. Folks, if you remember the last downturn in '08, it took the average investor 7 years just to get even. So from '08 to 15, you had no gains. That can devastate a retirement account, especially if you're drawing money out of there. You'd have no gains. But in this particular example, if the market would have went, so let's just say we put it in at the high, we're not sure what to do, and the market the next 5 years goes down 25% every year. I'm sorry, it goes down every year to a cumulative of down 25%. Not going to go down 25% every year. So let's just say it did that, which by the way has never happened. Okay, never have you had 5 years in a row totaling a down of 25%. Some years you probably had some ups, and the next year was even a bigger down. And those up years, using indexing, you actually get some credit. But let's just say it all fell apart as soon as you put the money in there. And 5 years from now, there's been no gains, and the overall market's down 25%. Well, that's something nobody wants to experience. But would you rather experience with your still $100,000 of cash in the account? Or would you like to have $75,000? And now let's say in year 6, in year 7, you have some big upswing, some big upside. Guess what? It's going to take you a long time to get back to your $100,000 when you're starting at 75. But when you're starting at 100, guess what? It's all gains from there on out. Folks, this is a really powerful strategy. You can use IRA money. You can use old 401k money. You can use non-IRA money, whatever funds you have. Minimum investment in something like this is $10,000. What are the downsides? I mean, all the glitters can't be gold, John. What is the glitch? What's the hitch? The hitch is very simple. This is not a place to put money that's going to be short-term money. In other words, if you think you're going to need this $100,000 in the next 2 or 3 years, might not be the best place to put it because they will charge you a penalty for an early withdrawal. It's not a staggering penalty. The highest you're ever going to pay is a 7% penalty for early withdrawal, and that's if you take it all out in the first year. Well, if you set up a program like this, you have no intention of taking it out in the first year. And every year that goes forward, that penalty will reduce. So 5 years from now, you need to take it all out for whatever unseen reason. Okay, you're going to pay probably a 2 or 3% penalty, but that's off the new account value. So if the new account value is up to 125, you got to pay a 2 or 3% penalty. You're still way ahead of the game. So that's really the only downside in this particular kind of an arrangement, is you have to be willing to let the money sit there for a while, let it protect itself, and let it grow. And if you can do that, why wouldn't you allocate some funds into this particular kind of an account? So email me directly. Email me at John D, as in David, John D. Jamieson, JAMIESON.com, and say, hey John, I saw that video. I want to see some numbers. Pretty neat. I need to ask you some questions. Can we get on a call together? The answer is yes, we can. And just reach out to me and say you want to see some numbers. We'll go from there. We'll get together on a phone call. And if you need to, watch this particular presentation again and send it to somebody you love. You got parents, grandparents, aunt and uncles who have money in the market. They're trying to leave it behind for you, maybe, or for somebody that you love. And they're worried about, hey, what should I do? Should I sell? Should I keep it in cash? Should I put my money in a CD? Give them this option. You owe it to them and yourselves. Again, this is John Jamieson. I want to thank you for stopping by. By the way, lower right-hand corner of the video, you're going to see a little icon with my picture. Click on it and subscribe to the YouTube channel. This is one of dozens and dozens of videos we have on here, and I'm going to be adding more all the time. Always good stuff, and we want you to be a member, so please subscribe. We'll look forward to talking to you soon. Thanks so much.